All right, Hunter, we've got a pretty exciting topic today, an exciting topic for you listeners. And I'm excited to get into this because a little over a year ago, we recorded a podcast episode on this and we got a little bit of hate for it. And that's because today we are talking about investing at all-time highs. And now not everybody thinks that that's the most exciting thing in the world, or they think, hey, you should time the market and look for a pullback. But today you and I are going to walk through and we're going to show you exactly why it makes sense to always be investing. And even when we are at all-time highs, it still makes a lot of sense.
Yeah, that's all the way back episode 14. And, it's one of our first video podcasts. So it's really fun to look back and see kind of where we've come from with this little experiment of ours. It's one of those things that, you take a look back, remember my college days, looking at markets, and if you can time the bottom and you're all trying to maximize your short-term returns, and it feels really good when you can, hit the bottom and then, oh, look, that was such a great investment. But on a broader, long-term and repeatable basis, that's, it's generally better, the data shows, to just invest along the way. Trying to invest at pullbacks, not a repeatable event. Feels good when it works out for you, but all-time highs to another degree, actually a better place to invest than on pullbacks.
Yeah, and I think we'll get into that here in a second, go through the data, because I think it is fascinating and something that I think our listeners are going to like to hear, especially for anybody who has some trepidation of, hey, we just hit an all-time high. Should we get into the markets? Does it make sense right now? And just taking a look back, we recorded that original episode June 18th of last year. Since then, we've hit 47 new all-time highs on the S&P 500. That's quite a lot in just over a year of market progress. And even just this year, we have hit 21 all-time highs on the S&P 500. So just because you hit an all-time high doesn't mean you're not going to see one for a while. They happen on a pretty regular basis, especially when you are hitting all-time highs. And that's something that we'll kind of get into in this episode.
And I think that's one of the big points of contention that kind of differentiates what the data show versus what public perception generally is that the news media and financial media make a big deal about all-time highs. It sounds very important, very unique experiences. But with a recent all-time high, hey, if we finish positive for the next couple of days, there's 2 more all-time highs. And so it's, kind of one of those things that all-time highs kind of beget all-time highs as the market, slowly ticks higher. So it sounds like a huge deal. And so that kind of makes people feel like it's an inflection point when generally it's just, a spot along the chart.
Right. In an ideal world, you would just have, if you could look from, point A to point B, avoiding all the volatility, you're going to typically see a higher point in the future. In a perfect world, the market would just tick up, a few hundredths of a percent each day. You wouldn't really have to worry about it. You wouldn't have to worry about the in-between period. And if you pick point A and point B from, 2 distant places in time, that's what your end result has been. But there's been a lot of fluctuations throughout the way. But at the same time, it's benefited people who have invested at those all-time highs, just as much as people really who have, waited for pullbacks, and in a lot of cases more so than people who have waited for a pullback, because they don't always come. And I think it's important to get into, and for you, the listener, taking a step back, why we get invested in the first place. It's just important to be making your money work for you. It's amazing to have a good job, be bringing in an income, putting money into savings. But then investing is just taking that to the next level. You're making that money work for you. It's making money essentially in your sleep while you're not even paying attention to it. And that just starts by getting invested in the first place. People worry too much about, hey, should I wait till a certain period of time? Oh, I think the market might be rough for a while. We always say it's worth putting in, a certain degree, maybe that's 40, 50% of an initial investment just on day one, because no one can tell you exactly what's going to happen tomorrow, next week, even next month. But over the long period of time, I can almost guarantee people that their money will work for them and see greater returns if it's invested. However, if it's in cash, it's probably not making you anything. Even worse, getting eroded by inflation.
And that's one thing that we see a lot is when people are either waiting for a pullback or, want to sell out at all-time highs in order to reinvest at a pullback, is you spend more time waiting than you do investing, or at least more time waiting than is optimal, because maybe you'll get a pullback, but your 10% pullback might be 15% from now, where you would capture that 5% investment return if you just invested in the first place, taken the ride along the way. Yes, you experienced a 10% pullback, but you're still 5% net better than you would be if you were waiting for that pullback. And it kind of goes back to one of the mantras of investing of time in the market beats timing the markets. And, that's, I think, very important to reiterate, even whether it's all-time highs or just dollar cost averaging in, get your money in the market in a certain format, but trying to time it usually isn't the way to do it.
Yeah. And let's now get into, the kind of hesitancy behind people investing at all-time highs. I mean, investing in general is a very emotional process. Your money, your life savings, in many cases, it is very emotional. And that's what our job is as financial advisors, as professional investors, is to take the emotion out of that equation for most people to lead to better outcomes. And of course it's emotional because you don't want to invest an all-time high and then see a pullback, and then all of a sudden your money that you just invested that you're hoping is going to grow is down 5% or so. Well, that may be the case, but we look at investing from a long-term perspective, and that's always important. You're investing, you're not trading. And this is a shout out to all those people who, or at least a few people who claimed we were looking for exit liquidity, and that's why we're pitching this podcast. We're long-term investors. We aren't trying to time the market or do a bunch of trading. And that's why we're trying to pick the best companies and best investments that we think are teed up for the long term. But we're not trying to trade around. We are not trying to time the market necessarily. Sure, we may, invest a little bit more capital if there's some on the sidelines when markets pull back a little bit. But I'm just as happy to invest at all-time highs as I am to try to wait. I'd much rather invest at all-time highs than wait. And so I think that's where it'd be helpful for us to get into some of the data side, talk through, what we see from a statistical perspective to help make that argument.
Yeah, and so we pulled together a lot of data sources for this, and for the first podcast and to revisit the same ones as well as updated news sources this time. And no matter how you slice the data, you're pretty much it works out to where investing at all-time highs is either your best option or right there tied with dollar cost averaging in, with the standout category being uninvested and or investing after dips. Because, like I said, all-time highs beget all-time highs. Generally, dips beget further dips. If you're at the start of a broader market pullback, a really big one, 20-25%, something like that, like really bad stuff, the investing after the first 10% isn't doing you a lot of good. You're still down with everybody else on the downside, but you're uninvested on the front side where people are making all of those gains.
Yeah, and I think I like referencing this data point that I pulled up on my screen here is some data that JP Morgan accumulated. Frankly, anybody could, looking back at S&P 500 returns. But the interesting thing is, because of your point that all-time highs, typically it means you're in a bull market, which means the market's going to continue accelerating or continue going up over some sustained period of time. Well, you're better off on a 5-year, 3-year, 2-year, 1-year, 6-month even basis, investing at that all-time high versus waiting, investing on any day, which is pretty remarkable considering that here in the data is showing that on a 5-year basis, investing at all-time high, your return would be 80.9% versus investing on any day, 74.7%. So you're talking right there, roughly 6% difference by actually investing at an all-time high instead of at any time.
Yep.
So I'm not saying, that's also not to say wait for an all-time high to get invested, but it does mean that if you're in a situation like we are right now where the S&P 500 has just hit a new all-time high, you don't need to wait for a lower market to get invested. It's time to make that money start working for you now.
Yeah, no, that's a really good point. And just for clarity's sake, whenever I say dollar cost averaging in, it's the same as investing on any day. It's the, investing on a regular cadence at a standardized dollar amount. Say I have, $10 per day to invest. That's what I'm investing dollar cost averaging in per day, or, whatever that might look like. And so that I think is really interesting because most of these data points do skew towards all-time highs. And, it's such a obvious thing that I think a lot of people kind of dismiss it or don't think about it, where your intuition just kind of generally tells you the opposite. But when you look at it, it starts to make a lot of sense that you're riding that bull market up, like you said, and, getting invested earlier is certainly better in those cases.
Yeah, exactly. And so I think now, hopefully that's a convincing argument. At least statistically, it's showing that, hey, you are, if not worse off, you're actually better off investing at those all-time highs. That there's certainly, we've established that there's no problem investing at all-time highs. Now it's how do you get invested? And I'd say that what we typically promote is, and I mentioned this earlier, roughly 40 to 50% of the sum that you want invested over a period of time, go ahead and do that day one. If you're doing it yourself, maybe an S&P 500 index fund. If you want to work with professionals, that's kind of the approach that we traditionally take when it comes to investing new dollars. Go ahead and get it in the market. And then, you can layer in the next 50 to 60% over 2 or 3 time periods, to your point, kind of that dollar cost averaging, where you aren't completely exposed to one time frame, but you are getting it invested in the market over a reasonably short period of time, maybe a couple of months, but certainly you don't want to be waiting years to get the rest of that invested, because the whole point is getting that money to work for you.
Yeah. And then one final point I want to make before we kind of move on into this, because I think there are a lot of other implications, especially tax implications of getting invested across time periods, having multiple lots, but also having the ability to, if you're looking at it and worried about the short-term returns of what it does tomorrow, the next day, maybe a week, that money should be saved in cash. If you have an expense coming up within a month or two, or even 6 months, maybe carve out your savings for that specifically. And I mean, right now, your overnight rate is 4%. You can get about 4% money markets. That's fine return in the short period whenever it's essentially guaranteed, money market 4%. That'll be good for short-term investing. Longer term is when you don't have to worry about so much what the market does next week. You're in it for the long ride from point A to point B, like you were saying earlier. And then on kind of back to where we were with, the benefits of getting invested, and especially like you were saying, over certain time periods, the way we do it in individual equities across different time periods, it makes for a lot of different tax lots, which the important part of tax lots is that it allows for tax loss harvesting. It allows you, if you need to raise cash for an expense, or if a position dips temporarily, you can harvest that loss for tax reasons and then buy the position back in 30 days or move those dollars into another investment that you like better. It gives you a lot more flexibility to work around and, allowing for that, capture of tax benefit, which is a big issue that, we're all working against.
Right. And just to break that down a little bit further for our audience is that the way that the government looks at it, or the IRS looks at from a taxable basis, it's your individual purchases, whether that's an ETF, a stock, a bond, some other kind of asset, and the date that that was purchased on, and those number of shares. So if I were to buy, 10 shares of Apple today and then 10 shares in a week, those are looked at differently from a taxable basis. So if the cost was $200 today and then $190 next week, well, they're going to have different taxable implications. So you talking about tax lots, it makes sense because, whenever you're managing those taxes, it may be beneficial to end up selling some shares that may be at a loss. You get a tax benefit from that. Or whenever it comes to the time to sell stock, selling those highest cost shares, which is going to have the least tax impact on your portfolio. And whenever it comes time for tax season. So by a combination of, of course, we're investing in individual equities, which allows us to have many tax lots, many options to help mitigate, your taxes when it comes to tax season. But if you're just laddering into something like an ETF, you can still at least have multiple lots by doing it over a period of time rather than just one single lot. Of course, we would vouch for the individual stock approach, but that is a more sophisticated, more time-consuming approach that is worth consulting someone on. But if you're trying to do this at your own at home, still might make sense to, at least if you're using an ETF, make a few purchases of that as you get laddered into the market.
Yeah, exactly. It can work really well for tax deferral reasons. Not even if you're not capturing those losses, if you have to, sell some of your S&P ETF exposure, well, at least you have more recent lots, or, as the market fluctuates, you have lots that are that higher cost basis that have a lower taxable implication. So it minimizes the impact and at least defers those taxes to a future time.
Exactly. And I think, as we're starting to wrap this conversation, I think it's important, and you really mentioned this when you're talking about saving cash for some kind of short-term purchase. If you have a house down payment you're going to make in, 3 to 6 months, you want that money in money markets or just in cash, because you don't want to worry about the short term. We're long-term investors, and that's the point that I want to make, is that you want to be invested for the long term. If you think about if you're investing in a relationship, in a business that you're starting, in some new hobby that you're doing, you're not expecting to, have that take off overnight. You're in it for the long haul. And so it's worth just letting time play out, be invested for a long period of time, because no one's going to be able to promise you results on an overnight or weekly or even a 1 month basis. But when you're talking about a multi-year perspective, you're certainly going to see returns and value from that investment.
Yeah, exactly. If they are promising you something with overnight huge returns, then be very wary of it, because if that was a thing, then I think we'd all know about it by now. And then finally, to wrap us up, I think I would like to take a look at the current picture, what's really different from a year ago or a little over a year ago when we recorded that first podcast. The underlying data remains the same. But what are the reasons right now that it makes sense to get investing? Because the AI megatrend has been going along since that last podcast, and it continues to chug forward. But do you want to offer up some more, big things that we're watching and reasons that now is a good time?
Yeah, and I think this is important, is you want to keep the grand, economic view, grand market view in context when you are investing new capital. And we have reasons to be positive right now. I think you've seen a really good market run over the last few years, but there's still reasons to be positive about the current environment. Sure, you can always get hung up in the details about, the small minutiae of things that may not be perfect, but the economy is still solid. Consumer spending still pretty strong. We're about to enter into a Fed rate cutting cycle, which is going to mean lower interest rates, which typically leads to higher asset prices, whether that's equities, bonds, real assets. So we're in an environment where things look pretty stable. Corporate earnings are pretty strong. And so those are a few things that come off the top of my head as far as, why we feel pretty positive about investing at this current moment at an all-time high. And of course, we'll have to get into the details of those things in future podcasts as we really dive into what makes us bullish on the current market.
Yeah, and one other thing I want to add to that I was thinking about while you're talking is, I've heard a lot of people say, because we're at all-time highs and, the companies have grown at whatever rate, the market S&P is elevated, and that's causing some concern with certain people who have a more bearish outlook, perhaps. And it's an opportunity that I'll take to kind of plug our approach to individual securities, because no matter what the S&P price to earnings ratio is doing right now, there are a lot of individual companies that are very attractive that we've been looking at that have like historically low price to earnings ratios and continue to see very good growth propelling them forwards, whether they're AI linked related or not. There are a lot of great companies out there right now that even if you think the broader market is at a high price to earnings, these individual companies still make very compelling arguments.
Right. And that's, coming back to why we would vouch for investing on an individual security basis, especially on the equity side. And that's where if you've got a more complex financial balance sheet, if you've accumulated significant wealth and you're worried about how to invest on a go-forward basis, I would definitely suggest reaching out to someone like ourselves to get some advice on that. Of course, we're always happy to offer people advice, whether they become a client or not. And but just bringing this podcast all together, getting invested, that's the important part. Don't be afraid to do it. If you've got a multi-year horizon, you're probably going to end up just fine.
Yeah, exactly. It's great thought to leave with them, and just investing for the long haul. Gotta love it.
Yeah, well, thank you for tuning into this podcast. If you watched the end, reach out to us, drop us a comment, give us a like and a follow, and we'll be giving you more content. I'm excited to get into what we brought up at the end of the episode, some reasons why we're bullish on the market, and the other factors that are coming into our thought process around investments.
Yeah, exactly. Thanks, Victor.